Thank you, Sanket, and thank you, Arvind and Sudesh, for inviting me. It's my third time I'm attending this conference, and I'm always happy to be here, and I'm very grateful to be part of this center and this event. So today I'm excited about being here, but also about your feedback, because it's work in progress, and you're all experts, and I'm sure you can help me to bring this paper to a higher level, much higher level. So the title is pretty clear. So the introduction, we all know that gold plays a very important role in India. Diwali, harvests, weddings, then it's often linked to culture. We've heard that already, and tradition. But the economic and financial role of gold is less clear, comparatively less clear. There's a negative role. We heard that today. Current accounts often mentioned, and a positive role as a tool to relax credit constraints for pledging or collateral. Also, as we've just heard, that it's people use it as insurance when they have a financial crisis or they're sick. So gold special role is reflected in the link. That's the question. Is this special role also reflected in share prices? And are those links, if there are links, and I can give you that there will be links, are those links due to a golden wealth effect, or more direct fundamental, because gold is part of the firm's business? For example, gold mining, that would be obvious anyway, that there's a gold, that the gold price is linked to a gold mining company. I mean, that's not surprising. It's also not surprising if the price of gold is linked to a jewelry company or a finance company that uses gold as collateral, that you will see. But there may be other firms where it's less obvious, and that could be due to a wealth effect. So the contribution, what I think is a contribution is that we provide a better understanding of the role of gold from a financial market perspective. And if there is a link for at least some Indian companies, we can provide a bit more information than just referring to culture, tradition, and emotions. And one important thing, and I have a simple graph to highlight that, is that a lot of studies, and I've done a lot of research on that as well, safe haven, is where we look at the role of factors that influence the price of gold. So what I do in this paper is the opposite, or the reverse. So you can see it here. Most of the existing literature I'm aware of, there's a lot of literature, looks at stock market or a lot of factors affecting gold. So to identify the role of gold as a safe haven, a hedge, diversifier, and so on. So in this paper, what I present now is the opposite. So how does gold influence the stock market, and specifically then company share prices? And what can we learn from that? Good. Methodology, very simple, because I'm a big fan of simple. If it's complicated, it's harder to get people excited about it, the industry. And I think there's also a lot of research that uses complicated models that are essentially useless, where you use a dynamic conditional correlation, IIMA, GACH, volatility, VAR, ARMA, whatever, right? And then, but you could just use a rolling correlation that would work well as well. So, yeah, the outline, methodology, data, empirical analysis, estimation, and summary. The data is, I have a lot of data, but I only show you the tip of the iceberg. So I consider this as simple. I hope you agree. It's on the left-hand side, I have the share price returns of companies or sectors. I use 100 sectors and 500 all constituents of the Nifty 500, for example, for India, but also for many other countries the same. So that's why I'm telling you it's just the tip of the iceberg, because I'm using many share prices of companies. So that's on the left-hand side, and then it's regressed on the local market return, a world market return, that's the MSCI World, and the gold price changes or the return of gold. Okay, and the focus then, of course, is on that BG. What is the coefficient what's the impact of gold price changes on the firm's share price. Yeah. You see an example here. For example, if the higher price of gold leads to a higher share price of a firm in the retail sector, which I find, then we can assume that the underlying cause is improved consumer sentiment, and that could be potentially a wealth effect or a golden wealth effect to make it sound nicer. And then I do additional stuff, time varying differences, quantity-dependent differences with quantity regression is only slightly more sophisticated, but I have nice graphs to show you what I get there. Good. So data, I use Thomson Reuters data stream sector indices.
What's the market?
The market? Which market? The RM is the, here it's, when I use the sectors, it's the data stream Indian market, the data stream index. And when I use the Nifty 500, then it's of course the Nifty 500 index return. That's the local market then.
But then what about in India? How many gold stocks do you have? They're very few, right?
How many gold stocks do I have? Out of the 500? Yeah, maybe, but you will see that there are a couple of firms that load on the price of gold, and that's then what I want to show you, and then you can tell me if that's interesting or not. Okay, just bear with me for like 5 minutes or 3. Yeah. Good. So here again, 100 sectors for India and a lot of other countries as controls, because I also want to show you that India is unique in some respects compared to other countries, compared to China, even compared to Turkey, that some people argue that Turkey has somehow similar characteristics in terms of the love and, or the affiliation with gold, or the desire to hold it. 500 firms for the Nifty, as I said, but then the same for many, many other countries. Good. So here, a quick graph that you see what we have. The Nifty 500 here went up significantly over that period, last 20 years essentially. The price of gold is hard to see. It's dotted a little bit too small, and then the world market index, like a relatively poor performance compared to the Nifty 500. Good. So then, what do we see here? That's a rolling correlation of you see that there on the left, average dynamic correlations of sectors based on daily data. So I used all the 100 sectors, okay, and looked at the correlation of all those sectors, retail sector, telecommunications, computers, automobile, and so on, looked at the link with gold price changes. And the black solid line is the average of all those 100 over time. And you see that it's essentially around 0. There's some variation here, some uptick around 2006, but essentially nothing really clearly significantly different from 0. And then we have the minimums and the maximums are up to 0.4, up to minus 0.2, just to give you an idea what we get here in general. But of course, that's not I will zoom in to get more information. So that's not what I should do. This is for monthly data, and then you see that the average is a little bit higher. Maybe not surprising that now on a frequency, when we look at monthly data, we see it's a little bit stronger than on a daily basis, which makes sense that the daily gold price changes may have an effect on some firms, but it makes sense that investors or consumers react more on a monthly basis when they think like the gold price has now really changed. Good, and here for all these sectors, some box plots. We're not surprised that for the local market, it's around 1. That's what we expect, right? CAPM world, MSCI world, close to 0, and gold, close to 0, but some variations. And what I want to do is to zoom in and look at what are the top 5 firms that load on gold, and the bottom 5 firms that load on gold. Maybe I see something interesting there. And before I do that, I can also show you the relationship between those betas, the world market betas and the gold betas. It's a negative relationship, and maybe more interesting, the lower graph, the when I look at the total volatility of all the sectors or the firms and the gold loading, so how they are related to gold, and I see that the higher the loading to gold is, the more risky they are. Which means that there may be positive things that firms have a relationship with gold, but in this case it also means that, well, it's not too strong, but there's some evidence that those firms that have a link to gold are more risky than firms that have no link to gold or even a negative loading. Good. So now, zooming in on those top 5 sectors for India, and I've done this for many other countries. Okay, and India is special. Now, if you look at this one, restaurant and bars, the gold beta not significant, but it's among the top 5 largest, 0.24. Restaurant and bars, there's no fundamental link because restaurants and bars usually don't sell gold, right? But that's what I meant with the golden wealth effect. You can guess that if the price of gold is up high, that then people are more confident to go to a restaurant and to a bar. Non-ferrous metals, that will be more the fundamental link, right? That's not surprising that there's some link of gold with non-ferrous metals. General mining as well. But then the other two, retail and broadline retail, again, there's no, unless those retailers do not sell gold products, there's more like potentially a wealth effect, right? So the price of gold goes up, you feel richer, and then you buy more. For the bottom 5, that's not the bottom 5, that's the bottom 5. There's nothing, if you have some ideas why, I mean, I don't have strong hypotheses here why these are negative, but that's not the, my point is more on the top 5, the positive links that are interesting, because the retail, as you've seen, retail, restaurant and bars is really potentially a wealth effect sentiment. And this is what something that I do not see for other countries, not for China, not for Turkey, not for the US, not for the BRIC countries in general, and so on. Good. Now for daily data, that's not daily, this is still monthly, but it is now not the sectors, but firms. So I have the 500 firms in the Nifty and run this regression, and then look again at the top 5%. And you can see that among the top 5 is PC Jeweler, All Cargo Logistics, then a sugar, Sri Renuka Sugar, sorry for my pronunciation, and then 2 finance companies. And they both do, they allow people to pledge the gold, and they give out loans using the gold, right? And here, that's now not a wealth effect, but more a fundamental link, right? That we see this positive correlation, that link with these firms. PC Jewel, of course, as well. And then here, the bottom 5, pharma negatively, NBCC negatively. So there's nothing. I don't know what I do with this, with the negative ones. Just wanted to present you those as well. But if you have ideas, tell me if I can use those bottom 5 as well. And then this is now monthly data, and for monthly data I have the PC Jeweler is now in the top 5, and also the Mathud Finance is still there. Okay, so it's a little bit different here for the monthly, for the daily. Daily we can see that by the number of observations is much higher here. But the Mathud Finance and PC Jeweler is still there. That makes sense, but the wealth effect is not so clear on a daily basis, which makes sense because on a daily basis, it's hard to imagine that if the price of gold changes on a daily basis, that then you go to a restaurant or that then you do stuff that is more based on a wealth effect. But on a monthly basis, it makes more sense, right? You wait, and then you know, like after a week or 2 or 3, the price is really up, and it's like, then you feel really richer. If you do that on a daily basis, it's would be a little bit overconfident. That means that I have only 5 minutes left, right? I guess. Well. So, and then here, that's an example of I told you that I do this for many, many other countries, the same thing. Here, this is for sectors, world without the US, just as an example. And you see that here's also all the usual suspects, right? Gold mining, highest loading to gold, not surprising. Platinum and precious metals, highest loading, yeah, fine. Mining, basic resources, non-ferrous metals, that's all not surprising. But it's very different to India, where we had retail and retail finance companies there, and restaurants and bars. And also Turkey, China, I don't find the retail, the restaurants and bars, I only find that for India. Here at the bottom, 5. Then I can look at asymmetries. Is this potential wealth effect, is it different for if the price of gold changes a lot on the upside than on the downside? And I find some asymmetry which kind of supports the wealth effect, because it's much stronger. If you feel richer, you actually go to a restaurant. If you feel poorer, it's not that you stop going to restaurants altogether. Right. Good. So this paper, if you've seen, is a first attempt to do the reverse. How does gold affect companies, and not the usual thing that we look at, what factors influence gold. Some Indian firms display an unusual and unique positive exposure to the price of gold, retail sector, retail finance, and there's an asymmetry, as you've seen. And so I think the results illustrate that gold's role is much broader and deeper than suggested by the ubiquitous references to culture. There's more. There's also financial market evidence. And one of the first graphs that I've shown you was that these relationships are relatively stable, which also suggests that not too much has changed despite efforts by the government to change things, and despite globalization and Bitcoin and blockchain and all these things. All right. Thank you.
Thank you, Dirk. Now we'll take questions from the audience.
Slide or comment or
Comment where you said
this one.
Relationship hasn't changed.
Yeah.
Why? How did that conclusion come about? Relatively stable gold.
Well,
no,
I mean,
the last one.
Yeah, but because here this is, I don't see from these graphs, right, and others, I don't see big changes here, right? I mean, there's some variation, but I don't see a clear trend. I don't see a structural break that at some stage, suddenly the relationship is negative or positive, right? I mean, there is variation, yes, but I cannot see any systematic there. That's where I get that conclusion from.
Did you see such a de-link in any, say, China in recent times?
Yeah, I haven't looked at that for the other countries, right? The focus there was on India, but I can have a look at that.
It'll be interesting if we know what happened in China, because it grew, the gold market grew exactly the same time as India's. Around 2009, late 90s India's and 2000 China. It'll be interesting to see if in China there was a big break.
Yeah, okay. Yeah, I'll do that. Somewhere here.
Yeah. So
On the daily.
the coefficient
The
is
daily
not
would be
too
here.
the coefficient for gold is, I mean, it's 0.1 to 0.2, right?
Yeah.
While if you go to monthly, it's like 0.9 to 1.1.
Yeah.
So is really, I mean, just want to understand, is it really dependent then?
Is it really depending?
I mean, it's not very different from zero.
Well, statistically, it's different from zero, and on a daily, given that this is daily data, those coefficients are, I mean, I would say even economically significant 0.2, right? So that means like 0.2 means that there's 20% is affecting the share price.
My question being, have you analyzed how much is explained due to gold and how much is explained due to other?
Of the R squared, yeah, I haven't done that, yeah.
Okay,
yeah.
okay.
Any other questions? I'll take the liberty of asking one myself. So when you're linking this, when you're looking at the channel of the wealth effect from gold to stock prices, could it be the other way around? Could it be coming from stock prices that people feel wealthier because their share prices are going up? And could that be inducing more gold purchases? And
Could be, but the problem that I always had, and would also be a problem here, is that we have then I would have to use local gold prices, right? Because if I'm using the world gold price, and then I don't know, it would be I think a strong assumption to say like, okay, if people in India feel richer, then they buy gold, and that this would have a significant effect on the world market price of gold. Right? I know that India plays a big role, but I'm not sure if that other channel would also work.
I doubt India's buying leads to any short-term changes in gold price. It's always a reaction to price rather than the other thing.
Okay. Say it again.